Chen. Now, shall we invite Director and Head of Listed Futures for Asian Institutional Client Group from Global Market Equities, Deutsche Bank, Mr. Russell Beatty, to speak to us.
Good morning, everyone. Thank you very much for having me here today. First thing I'd like to do is just go through some outlook of what we're currently looking for, our forecast for the commodity outlook for 2010. We're going to keep it fairly broad. It's a detailed subject. We've got our pitch books in front of you if you have. We also have a Chinese version as well, which we can gladly send through on email as well for you. A couple of things I'd like to just start off with as well. First one is our energy forecast. We believe that the rally in commodities has further to run. Prospects for further weakness in the US dollar and further lows is going to support this view going into 2010. Furthermore, a rally in the oil markets from these current levels is unsustainable, largely due to oversupply and constrained by the fragile global growth that we currently have at the moment. Industrial metals has been by far the best performer in 2009, and we believe that that will continue through in 2010. A lot of this has got to do, obviously, with the ability for China and the domestic demand for those products that are coming through, and this again is expected to continue in 2010. With the precious metals, mainly due to continued US dollar weakness, we see a sustained demand and support for precious metals going into 2010. Interestingly, central banks historically over the last 10 years have been net sellers. That has been since 1988. This year, going forward, we believe that central banks, particularly the emerging market central banks, will be by far net buyers of gold going into next year and will underpin the gold market going forward. The agricultural sector has significant structural factors which have been driving agricultural prices higher. Increased need to feed people, cattle, cars, and also environment of land and water constraints will continue to see very significant support prices in agricultural prices. And as from a trading perspective, seeing the short-term volatility gains from, you can see on supply issues in regards to agriculture, has seen very, very significant increases in prices in the short term. We've seen over the last 2 years, and particularly in 2009, as this graph will show you, is a very significant increase in consumer demand in regards to ETFs, exchange traded funds. This chart shows you from the US, and particularly in the last quarter, we're seeing significant amounts of funds coming back into the managed fund sectors, and as a result, the ETFs require a backing of physical commodities to support that. As a result, we continue to see some significant increase in demand in ETFs going forward. Now, this is what everyone's pretty well here to get an idea today. Everyone knows that the US dollars continue to be weaker, we all agree. The question is, when is it going to bottom out? Now, interestingly, this chart on the left-hand side shows on the long-term cycles in the US dollar, we usually on the downtrend, it tends to overshoot. As a result, if you see back into between 84 and 96, there was a 10-year down cycle of the US dollar followed by a 5-year up cycle. We believe that the US dollar has further down weakness to go, and as a result, there is a possibility that this, depending on the US, we're looking at probably out to 2011 before we actually find a bottom of the US dollar. So keep an eye on the US dollar. We continue to see it weaken, and as a result, it's going to be a main driver for commodity prices, particularly in the precious metals. This particular slide shows you a good example how basically we're seeing that the rock bottom of the US dollar is probably in September 2011. It's got a very, very similar cycle to the 1978-1995 cycle, and as a result, our projections are at this stage that we should see it bottom out around September 2011. The interesting thing that we've been seeing, as I mentioned before, since 1988, central banks effectively have been net sellers of gold reserves. What we're seeing at this stage, if you see right back into the lows in 2007, the emerging market sectors have basically been coming back out, and the central banks look like they'll be buying back the gold, and they'll be net aggregate buyers, which will support the prices going into 2010. In addition to this, ETFs and the increased demand for the exchange-traded fund market will see significant demand for commodity-backed funds as they are launched. As a result, this will continue to see both from central bank and private sector holdings to require to buy precious metals, and particularly the gold holdings, going forward into 2010 and even potentially into 2011. The slide that we have on the left here gives us a good opportunity to see. Obviously, the very, very significant fiscal expansion that's going on globally at the moment is seeing a significant effect this year, and basically we're seeing obviously the expansion in global GDP growth that's been going through. Coming back from a low of first quarter 2009, we believe that those stimulus packages will cap out and top in second quarter 2010. Then we'll probably see a correction and a pullback that basically will take us back into 2011. So as far as asset prices go, we're looking for the opportunities that they will continue to rise up until around second quarter in 2010, and then basically pull back. We don't believe we'll see first quarter 2009 levels. However, the correction will come through and will bottom out again around second quarter 2011. The reason why I keep discussing this is primarily got to do with the fact that the underlying global demand will actually support the actual global commodity prices that we're suggesting. Peak commodity prices will then hence peak out around second quarter 2011, and then we'll have 2010, and then basically we'll have that recovery period bottoming out in 2011. While there's continued demand for oil at these levels, and it's obviously linked with the global expansion that's coming through, and if you can see there we're forecasting an increase in demand in 2010. We don't believe that there's going to be significant increases of prices. The main reason behind that is obviously got to do with supply. We're looking for opportunities where there is excess supply balances at this particular point, and with the fragile global growth at this point, those prices will be able to be in balance. So significant increases in prices of crude oil going forward from these current levels is not forecast for next year. Continued weakness as well as far as oil goes. The interesting thing is that the OPEC demand